Good morning.
Can hear you, sir.
All right, good. So you're welcome to another class today. Today, we intend to look at two very short and interesting standards. And the very first of which is IFRS 5. And IFRS 5 talks about non-current asset held for sale and discontinued operations. So for this standard, from the name, we're going to be dealing with two items. So I want to start with the objective. So basically, we want to look at recognition and measurement of a non-current asset that is held for sale. That's the first item there. A non-current asset that is held for sale. Then we would also look at measurements and disclosures, measurements and disclosures of a discontinued operations. So today we are looking at two separate items that are put together in a standard, which is non-current asset held for sale and also discontinued operations. So let me start with non-current assets held for sale. Let me start with non-current asset held for sale. Yeah, Mr. Christopher, you want me to zoom in? I don't understand. Is it out or in? Like it's too small. I should bring it out like this. So when we say a non-current asset is held for sale, as the name implies, it means that the purpose, the objective of holding the asset is to sell it. So a non-current asset held for sale, this is an asset, or this is a non-current asset whose carrying amount will be recovered from sale and not from use of the asset. So when an entity has the intention that this asset, he wants to sell it, then that asset becomes a non-current asset held for sale. However, can you just wake up as an organization and describe your asset as held for sale? No, you cannot. Before you can classify your non-current asset as held for sale, it must meet certain criteria. Number one is that the assets must be available for immediate sale in its present condition. This first condition is very apt and straightforward in the sense that you must be ready to sell the assets immediately without any upgrade, adjustments, or any further work required on the asset. You must be able to release the assets immediately. So before you can say that your non-current asset is now held for sale, then you have to be sure that that asset is available for immediate sale in its present condition. And the second one is that the sale of the assets must be highly probable. The sale of the asset must be highly probable. When we say highly probable, what do we mean? It means that the management of the entity must be committed to the plan to sell the assets. They must be committed to it. And being committed to it also means that there must not be a change in the plan to sell the assets. Also, there must be an active program to locate a buyer. There must be an active program to locate a buyer, meaning that the assets must be marketed. You need to market the asset. And when you are carrying out marketing, the assets must therefore be marketed at a price that is reasonable in relation to its current market price. The asset must be marketed at a price that is reasonable in relation to its current market price. And finally, is that the sale must be made within 1 year. We need all these conditions, for a sale to be highly probable, all of these 5 must be present. All of these 5, all of it should be present. Otherwise, it is not highly. If only one of it is not met, it is not highly probable. Out of these 5, the only one that is a little questionable is that the sale must be made within 1 year. Because you could have all these 4. You might be committed that you are not ready to change. You might be marketing the assets and your price is the fair value is reasonable, but you are unable to sell. You can't find a buyer. And you know that since you have met all of this, you can classify the asset as held for sale while hoping that you sell it within 1 year. So what happens if you're unable to sell it within 1 year? So ideally, we expect that you should reclassify the asset back to where it's coming from, meaning as a normal non-current asset if you're unable to sell it. Except if you can show us that the reason why you're unable to sell is beyond your control and you are still making effort to sell, then in that case, the standard says, okay, you can continue to put it in your books as a non-current asset held for sale. But the question is, for how long? The standard didn't mention. Standard didn't mention. But I'm sure, based on practice, after a maximum of additional 1 year and you're still unable to sell, we'll revert it back to non-current assets. I mean, you need to understand why ensuring you sell within 1 year. You understand it very soon because you will see that we are hammering on it. That this sale, make sure you sell it within 1 year because you have said you want to sell. So if you are not selling quickly, that means you are just trying to create some account classifications to favor you. We don't want that. That's why we said, okay, since it's now a non-current asset held for sale, we need you to sell it as fast as possible. Now, when an asset is now classified as held for sale, depreciation on the asset classified as held for sale will cease, meaning as soon as you classified an asset as held for sale, you no longer depreciate the asset. It will cease. And the reason is clear. Depreciation is a systematic allocation of the cost or depreciable amount of an asset over its estimated useful life. In the case of an asset held for sale, we don't have any estimated useful life anymore. So there is no practical way to spread any cost anymore because now you want to sell it. So you don't have to allocate any cost anymore because now you want to sell it. And the money you're going to make from the asset will be recovered from sale and not from use. So the issue of matching income with costs will not even arise anymore. So depreciation is not necessary based on principle for a non-current asset held for sale. Also note that an abandoned asset is not an asset held for sale. When you abandon an asset, when you have an asset that you don't know what you want to use it for yet, but it is there, that is different from an asset held for sale. Therefore, depreciation must continue on an abandoned asset. You will still continue to depreciate it, even though you are not using it, even though you have abandoned it, because it is available for use. You are just the one that is not using it. Now, having noted that, when you classify an asset as held for sale, how do you measure such an asset? Measurement of non-current assets held for sale. How do you measure a non-current asset held for sale? So a non-current asset held for sale is measured at the lower of its carrying amount and net realizable value. And you know by now from IAS 36 that net realizable value is fair value minus cost to sell. The lower, which means that when you have an asset whose carrying amount is 30 naira and whose net realizable value is 40 naira, that means you will continue to measure the asset at its 30 naira. You will continue to measure it at 30 naira. However, if the net realizable value happens to be 20 naira, it means that you can no longer measure the asset at its book value. You then have to start measuring it at the lower, which is the net realizable value. And in this case now, since the net realizable value is now lower, it then requires that you will need to update your carrying amount. Since your carrying amount is the book value, you will seriously need to update it. And updating it means that you need to bring the asset down from 30 to 20. From the knowledge you have acquired in all my teachings, all your learnings in this class, when you bring down the assets from 30 to 20, meaning you write the asset down by 10. Who can tell me in this class the name you can call this 10? Anybody?
You can call it impairment.
Thank you very much, Yusuf. Impairment loss. Impairment loss. That's correct and apt. You see, a very intelligent student here would argue that why are we calling it impairment loss, Mr. Wasif? This is against IAS 36. Because IAS 36 requires that impairment loss is the difference, is the excess of an asset carrying amount over its recoverable amount. And recoverable amount is the higher between net realizable value and value in use. That this is not recoverable amount, this is just net realizable value. Why is then the difference between just these two? Impairment loss. Yeah, you have a very valid point. But IFRS 5 noted that and excused itself from that principle in IAS 36, saying that, please permit us to call it impairment loss for our case. And IAS 36 acknowledged that as well, that okay, the principle in IAS 36, so it does not entirely apply to IFRS 5. So we have allowed IFRS 5 to determine impairment loss as the difference between carrying amount and net realizable value. Remember again, if on this same assets there was a previous revaluation surplus, especially if this same asset is measured using evaluation model. Let's say there was a previous evaluation surplus of 5. You know that ordinarily, when you have impairment loss, you recognize it as an expense to P&L. But if there is a previous evaluation surplus on the same asset, then you cannot entirely transfer this 10 to P&L. You have to first net off the previous surplus in OCI. In such case, you will take 5 to OCI, which is enough to net off this surplus. You take 5 to OCI, and it is the remaining 5 that you can then take to POL. So if there is a previous evaluation surplus on the assets, then you take the 5 to OCI to net off the previous revaluation surplus, while the balance of 5 will be taken to profit or loss. And that is how you measure a non-current asset for sale. What then happens if you classified an asset as held for sale and you have made several efforts to sell, but you could not sell? Then the entity reclassifies. The entity reclassifies the assets back to non-current assets. It reclassifies it back to non-current assets. So you see, when an asset is reclassified from held for sale to its normal non-current assets, the assets will be measured at the lower of the carrying amount of the assets after adjusting for all the depreciation that were not charged when it was classified as held for sale. So if at the date you want to reclassify it back to its normal non-current assets, you ask yourself, what was the carrying amount at that date? Let's say it was this 20. You will now deduct the depreciation you did not charge. Remember, when you classify an asset as held for sale, you will not charge depreciation. So all the depreciation you did not charge, you then deduct all of that from the asset. You deduct all the depreciation you're supposed to charge and you did not charge, you deduct. So whatever value you have, that is the carrying amount of the assets after adjusting it for all the depreciation that were not charged when it was classified as held for sale. And secondly is that you compare it with the recoverable amount of the assets at the date of that reclassification. And the recoverable amount here can go as the net realizable value. And this is substantially how you measure a non-current asset held for sale. Okay, yeah, Latif, I can see your hand. Please ask your question.
Yes, sir. Good morning, sir. Can you hear me, sir?
Yes, I can hear you. Good morning.
Thank you, sir. As per what you just explained now, that when the asset is not sold within a year, it has to be reclassified again as a non-current asset. However, you mentioned that all the depreciations that were not charged while the asset was classified as held for sale. So somebody will have to adjust for those depreciation before we now reclassify it. So where do you post all those depreciation?
Okay. So you're not posting it anywhere because you are not even charging the depreciation. It is at the point of reclassification. At the point of reclassification that you have to calculate it. That, okay, if I hadn't reclassified this asset, I would have been charging the depreciation. Because you will know now, because you were charging depreciation before you reclassified. Then you had to stop when you reclassified it as held for sale. You had to stop. So you know how much you were charging per annum before. Let's say you stopped for 2 years. Let's say you stopped for 2 years and you were charging 10 naira as depreciation. So that means to get this figure here, whatever the carrying amount is at the date of that reclassification, let's assume it's 20. And let's say the depreciation per annum you were charging before you stopped that depreciation was, let's say, 5 naira. And this asset you have held it for sale for like 2 years. That means you have to deduct 10 naira. So it's not like you were keeping the depreciation somewhere. No, you were not just charging it. It is now that you want to return it back to its normal non-current asset that you need to reawaken those depreciation that you did not charge to get what the carrying amount to actually be. And also you compare that with its recoverable amount. All of this is just to ensure there are no loopholes in accounting. Some people can just decide and say they want to reclassify it for whatever reason, just to achieve a purpose. They can do all sorts. People think about a lot. So we are also trying to avoid all of that, which is why all these are coming up.
Okay.
Now,
So,
is there another question?
yes, I want to ask a question that
Okay, look.
can an asset that a company decide that, oh, they are going to sell it, but they are still using it, like they are still deriving one or two things from it while they are still, operating. Can they still recognize it as held for sale because they want to sell, just like motor vehicle? Oh,
Yes, they can.
okay.
Yes, they can. But I need you to understand something that even though they are still using it, can they release it immediately? If a customer comes today and say, okay, I want to buy, would they be able to release it immediately? If the answer is yes, then that means it's available for immediate sale in its present condition. So it does not preclude the entity from using. You can still continue to use it. What is important for us is that now you have intention. Intention is important in reporting.
Okay.
And we want your figures to reflect that, because that's what we call faithful representation, because that's the economic activity. That's your purported activity of the organization. So your intention is to sell it. You can use it for whatever. You can continue to use it in your factory. However, does it meet those conditions? Is it available for immediate sale? Is the sale highly probable? If it checks those two boxes, then fine. Then all of these principles would then apply. Okay, let's take question from Chineye.
So please, I just want a clarification with when you're trying to reclassify the asset back to non-current asset. I was thinking when one can depreciate an asset is when the usefulness is being flown back to the organization. Now the organization have not used that particular asset, say an apartment, maybe because they are moving a short let or something, or any other asset in fact, because is a non-current asset. You vacated there. You did not use it because you want to hold it for sale. It's being held for sale. How are you now charging it to the company whereby the benefits didn't flow back to the organization? Why should it form a cost, like a part of expenses, sir? I just need clarification. Thank you.
Uh, Suchine, I didn't quite get your question very well, but it doesn't form part of expense. Classifying an asset held for sale doesn't make it an expense, it's still an asset. Just that is now it's not the classification it used to be, which is where I'm going. How you now present it. So it is not an expense. In fact, the only expense here is the impairment loss when you're trying to measure it. That's the only expense here that we have. I don't know if I answered your question one way or the other.
So what
Chineye,
I'm trying to say, so what I'm asking is the depreciation. Why should we account for the depreciation? Because I was thinking asset is being depreciated when the organization is utilizing it. When you're utilizing an asset, you're reducing it, you're depreciating it. But now you didn't use the assets. Why are we still depreciating it before reclassifying it? Why are we recognizing the depreciation before reclassifying it back to assets, sir? Because we stopped the depreciation, we are not using it. Now that we want to start using it. I was thinking it's from that year we want to start using it. We'll now start charging for the depreciation. But for the past 2 years, we did not use it at all. Why should we account for that depreciation? That's my question, sir.
okay, now I get your question. So the logic is this, Um, so depreciation is majorly not because you are using an asset. That's not the essence of depreciation. Depreciation is an allocation of costs. You are just spreading cost over its useful life. That's all you're doing for depreciation. And depreciation, you don't have to use an asset before you depreciate it. You commence depreciation when the asset is available for use. However, when you now want to sell an asset, and we believe you have to sell it within 1 year, so that spreading of cost, the aim of depreciation does not apply again because you are selling the asset immediately, meaning that asset will be expensed and you pick a profit from it. So the main aim of depreciation does not apply there anymore. However, when you now want to reclassify the asset back to its non-current asset, so the message here is that when you want to measure, you are going to measure it at the lower, you are going to compare the carrying amount of the assets, then adjust for all depreciation that were not charged, all the depreciation you did not charge. So the aim of this one is just to avoid accounting shenanigans. It's just to avoid creative accounting and window dressing. Some people might just want to come and overvalue or depress the value of their assets by simply reclassifying. So we want to avoid all of that and say that you would need to charge all the depreciation you were not charging before while it was classified as held for sale. Because now your intention has changed that you want to continue to use the asset. So that gap in depreciation that you did not charge, we expect you to now charge it. Otherwise, there will be gap in accounting. There will be a missing link just because you decided to say you want to classify and reclassify. Otherwise, accounting will become a joke. People will just be doing anyhow. So the aim of this is that even when you classify and reclassify back, let's look as if you did not even classify. Let everything be tight in our report. Not like because you classified as held for sale some years ago. During that period, there was no depreciation. It should not be like that. In order to have a complete and reasonable report, it makes sense. This their requirement is rational. That all the depreciation you have not charged before, now charge it. And L for sale doesn't mean you're not using it. Like Lukman asked the other time, you can still be using it. And if you're not using it, fine. But that is not our own aim for L for sale. L for sale is the intention is that you want to sell. So whatever you are using it for doesn't matter again to us. But make sure you sell it within 1 year. Make sure you, and if you then decide that you don't want to sell, let it look as if you did not even classify it as L for sale. Close any gap. Charge the depreciation you did not charge that year that you classified as L for sale. Recognize it in the year you decided to, okay, I don't want to sell again. So accounting is tight that way. And don't overlook this second point, the recoverable amount of the assets. You were actually looking at the lower of the two. The lower. So don't just concentrate only on, okay, the carrying amount after removing all the depreciation you did not charge. No, don't concentrate only on that. Also get the recoverable amount of the assets and get the lower of the two. That's what we're looking at.
All right, thank you, sir.
You're welcome. Now, the final thing here is this. Presentation of non-current assets held for sale. So when an asset is held for sale, how do you then present it? How do you present it in the statement of financial position? So it will be presented as a separate line item, okay, after current assets. After current assets. So it doesn't just automatically becomes current asset like that. But you are taking it away from it's no longer a non-current asset. That is clear. We know that it becomes current based on the definition of current assets. It's an asset you want to realize within 1 year. So, but you're going to put this non-current asset held for sale as a separate line item after your current asset. It will just be there as a separate line. So meaning that if you have in your statement of financial position, if you have non-current asset 100, you have current assets 50. Underneath it, you have non-current assets held for sale. We want to see it separately so that everybody will know that, okay, you present it as a separate line item. And you need to give us some disclosures in the notes to the account for this non-current assets. You need to give us a description of the non-current assets, which you need to tell us which assets are you selling. You need to tell us the reason for why do you want to sell. You need to tell us the basis of measurement. How do you then eventually measure it? Was it the carrying amount? Was it the non-current? Was it the net realizable value? You need to tell us the measurement of these non-current assets. And finally is that if there's any impairment loss, you need to separately disclose it to us. Let us see the impairment loss, if any. And that is it about non-current assets held for sale. Now let's hear another person's voice. Is Femi around today? We could not read yesterday.
Good morning, sir.
How are you?
Fine, sir.
So can you please read for us?
On 1st December 2013, a company became committed to a plan to sell a manufacturing facility and has already found a potential buyer. The company does not intend to discontinue the operations currently carried out in the facility. At 31st December 2013, there is a backlog of uncompleted customers' order. The company will not be able to transfer the facility to the buyer until after it ceases to operate the facility and has eliminated the backlog of uncompleted customers' order. This is not expected to occur until May 2014. You are required. Can the manufacturing facility be classified as held for sale at December 31st, 2013?
Thank you very much. So on 1st of December 2013, this company became committed to a plan to sell a manufacturing facility and has already found a potential buyer. Company does not intend to discontinue the operations currently carried out in the facility. So at the end of the year, 31st of December, there's still a backlog of uncompleted customer orders. So the company will not be able to transfer the facility to the buyer until after it ceases to operate the facility and has eliminated the backlog of uncompleted customer orders. That is not expected to occur until May 2014. Can they classify it as held for sale as at December? No. No. It cannot classify the manufacturing facility as held for sale because the facility is not available for immediate sale in its present condition. It's not available. So we cannot classify it as held for sale because it is not available for immediate sale. Because as at December, there's still a backlog of uncompleted customer orders. Let me write it there for the examiner to see. So, and they said they cannot transfer the facility to the buyer until they have eliminated these orders. And this will not happen until May. So it cannot be classified. It is not available for immediate sale. Please read the next section.
May Limited had the following asset at 31st March 2014. A property that is offered for sale for 10 million naira during June 2013. The market for this type of property has deteriorated, and at 31st March 2014, a buyer had not yet been found. Management does not wish to reduce the price because it hopes that the market will improve. At 31st March 2014, the entity received an offer of 8 million naira and the property was eventually sold for 7 million naira during May 2014, before the financial statements were authorized for issue. Require, can the property be classified as held for sale? Its year end is 31st March.
Thank you very much, Femi. So can we classify it as held for sale as at March? So in March we had the following assets. We had a property whose selling price is 10 million, which we want to sell. I want to sell it during June 2013. And the market for this type of property has deteriorated, and as at March, a buyer has not been found. We did not find a buyer. So management does not wish to reduce the price because it hopes the market will improve. So after March, the entity received an offer for 8 million. I'm sure he did not agree. And eventually, they just sold it for 7 million in May, before the financial statements were authorized for issue. Can the property be classified as held for sale? Okay, let me allow you respond to this. Let me hear your opinion. Hello, can you hear me, please? Can I hear your opinion on this? Can we classify it as held for sale as of March?
No, sir.
No. Why?
Because as at um because at 31st March, the management has not made proper provision for advertisement or the promotion for the property to be sold.
So maybe you're correct. No. It cannot classify the property as held for sale because as at March 2014, the assets was marketed at a price that is not reasonable in relation to its current market price, which is why they were unable to sell it. You know, they will have sold it, but they said that, no, we are not going to reduce our price. We're not going to reduce our price. Even in March, somebody came and offered them 8 million. They said no. Eventually, they now sold it for 7 million. So why this question is important is that some people might say, Shibi, they have sold it in March before the financial statement were authorized for issue. And they might think it's an adjusting event. No, it's a non-adjusting. So even though this one, they were able to sell it only after the end. Only after the end. So you will not go and then, because of that, classify the asset as held for sale as at the end of the previous year. No, you will not classify it as held for sale because we are not marketing it at the price that is reasonable. Good one, Mary. Let's look at the next question, please. This one
An
is very...
asset,
Susan.
Yes, Latif, you want to ask a question?
No, I just want to tell you that that solution help us to put us at 31st March in that 31st.
Okay. All right, thank you.
You're welcome, sir.
Okay, please go ahead.
an asset is reclassified as held for sales when its carrying amount is 10 million naira. Its fair value less estimated cost to sell is 7 million naira. How is the asset going to be measured?
Okay, it's measured at the lower of its carrying amount and net realizable value. In this case, The lower is what? Is the net realizable value of how much? Of 7 million. Additionally, the entity will recognize an impairment loss of 3 million. I hope you know that if it was the carrying amount that had been lower, this impairment loss will not be necessary. I hope you know that too, because the carrying amount will have been the book value, and there won't be need for any change in the books. The only reason why we are having impairment loss when the fair value less cost to sell is lower, because at that point you then need to change this 10 million from 10 million to 7. You need to reduce the value of your asset. That's an impairment loss. That's the only scenario where impairment loss will arise. Okay, next question, please.
An asset is reclassified as held for sales when its carrying amount is 20 million. Its fair value less estimated cost to sell is 24 million. How is the asset going to be measured?
So an asset is reclassified as held for sale when its carrying amount is 20 million. How is the asset? Okay. This one is even more straightforward. So it is measured at the lower of its carrying amount and net realizable value. In this case, the lower is the what? Is the carrying
Net
amount
book value.
of how much?
20 million.
And that's it. This one doesn't need any impairment loss because that's lower. Okay. Then the next question is past corrections. Then. Okay. So before we move to the next question, let's talk about the second part, which is discontinued operations. Remember, this standard talks about non-current assets held for sale and discontinued operations. So to put a very good context to what a discontinued operations mean is like an operating segment. For those of you I taught operating segments on yesterday, is like an operating segment. And for those of you I started teaching group accounts yesterday, discontinued operation can be a subsidiary. So that should open your mind to discontinued operation is a company on its own or a branch of that company, but is related to this reporting entity in question. That's a discontinued operations. So a discontinued operations is a component of an entity that is either disposed of or held for sale. Is a component of an entity that is either disposed of or it is held for sale, and it is a separate line of business.
Sir, what you are
Or
typing is not showing.
Industry.
Are you serious?
It was showing, maybe it's your own.
Oh, it was showing. Okay. Jacob, you need to actually check your this thing. And it is a separate line of business or is a separate geographical area of operation. So, or we can say that is a coordinated plan, to sell a separate line of business or a geographical area of operation, or it can be a subsidiary that is acquired with the intention to resell. Okay. You should be able to know this definition by heart. Yeah, you should. It can earn you some marks if asked in the exam. So after building a context for you, making you understand that a discontinued operation is a company on its own or part of a company, then I came about this definition from my IFRS 5 that says that is a component of an entity. And it is either disposed of or held for sale. So it's either you have sold it or you are holding it for sale. Okay, sometimes you might see it as a disposal group. Sometimes you might see it as a disposal group. And it's a separate line of business or a geographical area of operation. That confirms that it could be a segment, it could be a branch, it could be a subsidiary like that. Or it could be just a plan to sell, meaning that you are still holding it for sale. It could be a coordinated plan, meaning you are not sold, but you are still holding it for sale. It's just a plan to sell, either a separate line or geographical area of operation. And also, it can be a subsidiary that you bought, and your intention of buying that subsidiary is that you want to sell it. Your intention is that I want to sell this asset. That was why I bought it. And that is a discontinued operations. So now, having a discontinued operations, yeah, Latif, I can see your hand, please. Go ahead before I make my next point.
Okay, sir. The third one that you just said, it could be subsidiary that is acquired with the intention to resell. And if I may recall that, whatever you acquired with the intention to sell, it means that we can equally classify it as an inventory.
Okay. So you want to classify subsidiary as inventory.
I'm bringing that knowledge to this. What can you help me on that?
No, I cannot help you. I was just joking. Latif is clear now. This one is a company, that one is goods or services. Discontinued operation is a company you want to sell. Inventory is goods or services you want to sell. They are different now.
Okay, sir. But since you said in your explanation that intention matters, that's why I just brought it up. Thank you, sir.
Okay. So, when you have discontinued operations, majorly, you are expected to, so the discontinued operations should be presented separately in the statement of profit or loss. Statement of profit or loss under an heading described as discontinued operations. Additionally, the assets and liabilities of the discontinued operations should be classified as held for sale in the statement of financial position. Note that the assets and liabilities of a discontinued operation that is presented as held for sale should not be net off. You can't net it off. You have to present them separately. The assets presented as an asset, the liabilities presented as liabilities. In line with what I taught you under held for sale, you present them after current asset. For the liabilities, you present them after current liabilities separately. Don't net them off. So that means that in the statement of profit or loss, you then have something like this. You have continuing operations. You have your revenue, cost of sales, like that, like that, like that, like that, like that. Like that. Then you now have another one after your profit for the year. You now have discontinued operations as a separate heading. But that's what you need to put is the post-tax profits of these discontinued operations. Just put a one-liner item, post-tax profits. Then you need to give the breakdown in the notes. Give the breakdown in the notes to the account. That is when you go and show us the revenue, the cost of sales, and all of that. But you can just give us the post-tax profit. And if you have eventually sold the discontinued operation, you also give us the post-tax gains from disposal of that discontinued operation. You know that there are some discontinued operations that you were holding them from the beginning to, like, let's say September. You now eventually sold it in September. So that means their report from January to September, you present it as discontinued operation. Then whatever profit you made from selling that operations, you also present that profit under that discontinued operations like that. That's how it actually works. And for the asset and liabilities of that discontinued operations, present them separately, just like I taught you under non-current asset held for sale. Present them separately in the notes, in the statement of financial position. The assets presented separately under asset, liabilities presented separately as liabilities. And that is it for discontinued operations. So there are some disclosures that are required for discontinued operations. I think I have, Ufama wants to ask a question. Please go ahead, please.
So what about this continue operation? Can you explain that, please?
Oh, this is your normal operations, your other segments that are still in operations. If not that you had a component of your entity that you want to sell, this one will not have been there at all. You will have, in fact, you don't even need to put discontinued there. You will have just prepared your statement of profit or loss normally. But because you have discontinued operation, you want to sell or you have planned to sell a component of your entity, that is why you are saying, okay, let's classify our operations, the component of our entity that we are not planning to sell as continuing operations, and the ones that we want to sell as discontinuing operations. So that's the idea for this. We're just separating it from the ones we want to sell. Hope that's clear.
Yes, sir. Thank you.
All right, Manuel, go ahead, please.
Okay. But sorry, can you just briefly tell us how this impacts the statement of financial position? This activities on discontinued operations.
Okay, so it doesn't impact it in any way because the profit you will get after whatever profit you get here and the profit from the discontinued operations, you add them together and you take them to your equity as usual. Aside that, the asset and liabilities of that discontinued operations should be presented as assets and liabilities held for sale. The assets held for sale will be presented separately. The liabilities held for sale will be presented separately. And that's how it works. And I also believe that you should agree very well with this standard, asking us to do this separation. It makes so much sense because users can then easily see that, this company wants to discontinue some of their operations. It will be clear. Then users can be able to make informed decision about investing decision in the company or not. I mean, when GSK left Nigeria some years ago, people were shouting. But in reality, when you check their financial statement as far back as 2016-17, they had already been presenting discontinued operations. They had been planning to sell segments. They have been shutting down operations. So people that had been looking at their reports would know already that this company is about to leave, and they will not be shocked when they left. So informed investors that study financial statements have seen it because of the requirement of IFRS 5. So it makes sense. And again, it makes more sense because users can then see why this company wants to discontinue because they can see at a snapshot the post-tax profit or loss from these discontinued operations. They would see that he's making so much loss and that is why they want to discontinue. Or they will see that he's still making profits. Why do they want to discontinue? Then they will ask further questions from them. So it makes sense. This separation is really useful for decision making. It's useful for decision making. Okay, I was just holding on if you had other questions, but I'm not sure there is any. So when you have discontinued operations, you're expected to give a description of the discontinued operations. Also, you're expected to give us the reasons for the discontinuation. And also, you need to also try to, if there is any additional costs incurred as a result of the discontinuation. You need to present that separately. You need to disclose it to us. Let's know any cost you incur because of this discontinuation. If there is any impairment loss on the asset of the discontinued operations held for sale, impairment loss on the assets of the discontinued operations. You need to disclose it to us. Okay. So, and that is that for IFRS 5. Okay. So, Femi, please read this question for us.
International Financial Reporting Standard. On non-current assets held for sale and discontinued operations specifies the continued treatment for assets held for sale and disclosure of discontinued operation. Required. Discuss the condition which must exist in order to classify a non-current asset as held for sale and explain the accounting treatment that apply when such classification is deemed appropriate.
Okay. Okay, hold on. Sorry. Let's sort this one first. This can serve as a revision for us. So, solution A. The question says, it says that it says discuss the condition which must exist. So, conditions to classify an asset as what? As held for sale, a non-current assets as held for sale. Number one, we said the assets must be what?
Readily available for immediate use.
For immediate sale in its what?
Present condition.
In its present condition. Number two is that the sale of the assets must be
probable.
highly probable, and this means that management must be what? Committed to the plan to sell the assets. There must not be a change in the plan to sell the asset. Number three, the assets must be marketed at a price that is what? That is reasonable in relation to its what? To its current market price. Number four, there must be an active program to do what? To locate a buyer. Number five, the sale must be completed within 1 year. And explain the accounting treatment. So the accounting treatment for a non-current asset held for sale, number one, is that the depreciation on the assets will stop and the asset will be measured at the lower of its what? Of its carrying amount and net realizable value. And if the NRV is lower an impairment loss will be recognized to profit or loss. Okay, this should be a revision for you. Femi, please, let's read the B part.
Whiskey Bottling Company PLC specializes in the production of alcoholic wine known as Blue Bull and soft drink called Whiskola. Hence, the company operates two divisions, i.e. Blue Bulls and Whiskola division. Due to high cost of labor and shortage of raw material for production of the wine, the Blue Bull division has incurred significant operating losses. Management decided to close down the Blue Bull division and draw up a plan to discontinue operations of the division. On February 1st, 2019, the Board of Directors of Whiskey Bottling Company PLC approved and immediately announced the former plan. The following figures are available for current and prior year ending March 31st. Additional information. The following additional costs are directly related to the decision to discontinue operation and are yet to be accounted for. Severances pay of 42.5 million was incurred between February 1st, 2019 and March 31st, 2019. A proper evaluation of the recoverability of the asset in the Blue Bull division in terms of IAS 36 led to the recognition of an impairment loss of 9.5 million, which is included in other operating expenses above. You are then required 1. Draft the statement of profit or loss for Whiskey Bottling Company PLC for the year ended March 31st, 2019, together with the comparative figures for the year 2018. 2. The Director of Finance of Whiskey Bottling Company PLC stated that there should be some additional disclosure about the discontinued operations, which should be shown in notes to the financial statements of the company. Identified 3 of such disclosure required in accordance with IFRS 5.
Thank you very much. So the A part of this question requires us to draft the statement of profit or loss of Whiskey Bottling Company for the year ended 31st March 2019, together with comparative figures for 2018. And they also want us to identify 3 disclosure requirements for IFRS 5, with IFRS 5 for discontinued operations. Okay, so what's happening here? So I can see that this company has 2 divisions, Blue Bull, Whiskola, and so they have decided to shut down Blue Bull. Okay, so they give us the report of Blue Bull and Whiskola for 2 years, and they want us to prepare P&L. Okay, yeah, sorry. So we're required to prepare the statement of profits or loss. So this is the solution B part. So prepare statement of profit or loss for the year ended, which period? March 31st, 2019. So for these statements, because the company has a discontinued operations, which is Blue Bull, that they want to discontinue. For that reason, we will need to separate the continuing operations from continuing operations. So we'll have continuing operations, and we'll also have discontinuing operations. For our continuing operations, which is Wiscola, we'll pick his revenue for Wiscola. And the revenue for Wiscola for March 2019, there is March 2019 and there is March 2018. For March 2019 is 1570. Don't forget the Naira amount. And March 2018 is 1250. Then the next item is our cost of sales. Pick our cost of sales. For March 2019 is 505,000. And for March 2018 is 450,000. Then that gives us our gross profits.
1,000,007.
What's 1,570 minus 505?
560. 1,065,000.
1,065,000. And 1,250 minus 450. That's 800,000.
800,000.
Then you'd have our administrative expenses. Now for administrative expenses for Wiscola, we have 311,000. And the comparative period, we have 255,000. That's the administrative expenses. And the distribution costs, and for the distribution costs, for 2019, we have 186,500. And for 2018, we have 157,500. That's our distribution cost. And our other operating expenses, we have 124,500. And for this, we have 102,500 for other operating expenses. Then we can then determine our profit before tax. What would this give us?
Hmm. 443,000.
443,000. And for March 2018, The income tax.
285,000. Okay.
285,500.
Thank you. The income tax for 2019 is 130,500. And for 2018, that's 85,000. Then we have our profit for the year. So what's our profit for the year?
312,500.
312,500. Why this
200,000.
200,000? Now, for the discontinued operations, you can just have the post-tax profits from discontinued operations. I don't have to write that. Then in my notes, I can then break it down into March 2019, March 2018. My revenue for Blue Bull, I have 235,000. And for 2018, I have 250,000. Then my cost of sales, for Blue Bull, I have 175,000. And for 2018, I have 200,000. I
50,000.
have my gross profits. What's my gross profits?
60,000.
This 60,000. How much is this? This 50,000. My administrative expenses. Let's not forget this severance pay that they incurred on these discontinued operations. We need to remember to add it. And also, there was an impairment loss on this discontinued operation that they have already added in operating expense. So we need to also remember to consider that as well. Okay, but let's go. My admin expense for this guy is 35,000. Well, this one is 25,000. Then my distribution cost. Distribution costs is 20,000 and 10,000. 20,000 and 10,000. Then my other operating expense, they already included this impairment loss of 9.5 in this 15,000. They already included. So it's advisable that you'd separate that. Let me do 15,000 minus 9.5. 2 minus 9.5. That will remain 5.5. And for the previous year is how much? This is 10,000 as well. And just come and present it separately here. That impairment loss, just present it separately to be dash here. And also the severance pay of 14.5. So my profit before tax. So let's do 60 minus 35 minus 20 minus 5.5 minus 9.5 minus 14.5. That's a loss. That's a loss of 24,500. While this one is 50 minus 25 minus 20. That's 5 profits. At least now we can see the reason why they want to discontinue it. The profit-making segment. Then income tax for the year. What was my income tax? In this case, there's a credit. There's a credit of 3. So when they say income tax credits, it means that you are not paying tax. They are in fact giving you back some money. So while in the previous year we had 1.5, that is the normal expense. So profit for the year, this 24,000, net it off against the credits, it reduces our loss to 21,500. And this is 3,500. So I can come here, I discontinued operations, loss of and this will give me 3,500. So profit for the year from all operations, so 312,500 minus 31, this 291,000, and this is 203,500. And that's the end of this question. So it's not difficult, but you just need to be careful and do it properly. Okay, Ufoma.
Is there no calculation for the gain on disposal or loss on disposal?
They didn't tell us that they have sold the division. They are only they only plan to discontinue, they have not sold it. So if they have sold it, that's when we'll be putting gain on disposal. And they have asked a similar question before. They asked it at professional level. This one we solved is the one they asked at skills level. It's just the same question they asked for the two levels. So this is for the one they asked in professional. I'll advise you to attempt it. It's the same question. Just repeated the same thing. You can use that to practice this. And there's this another simple one they ask at the professional level. They ask it a lot at professional and also at skills also. This is also a very simple one. Just to apply those principles, attempt it, let's see. And also, this one was asking for disclosures requirements, which I already gave here. You can just pick it here and use it. So this is the end of this topic. Supposed to move to the next topic, but there's something that just came up that I had to attempt. I just needed to finish this class. So we'll stop here for today, then we'll
Thank you,
continue
sir.
later. So for my other students, we are going to be having our class by 7 this evening so that we can continue what we started yesterday. All right, thank you very much. See you in the next class.
Na good day to see.
Yeah.